Hey, I'm Jonathan Wild, and we are going to cover how to use the direct write-off method. In business, we sometimes allow customers to pay for products or services at a later date, called granting credit. Now, unfortunately, some of those customers won't pay us back. This could be because they are having financial troubles, or they never plan on paying us back in the first place. Whatever the reason is, we call these uncollectible accounts or bad debts. So if we know that some customers won't pay us back, why do we sell on credit at all? It's because companies believe they will have more sales by offering credit, which hopefully makes up for the bad debts. Okay, so let's run through how to account for these bad debts. Using the direct write-off method, we record a loss from an uncollectible account receivable when we determine it to be uncollectible. This might be when a customer goes out of business, or we know for whatever reason that they won't be paying us back. As an example, assume we determine that we cannot collect $800 owed to us by a customer Weber. To record this entry, we debit bad debts expense for $800 and credit accounts receivable for $800. We debit and increase bad debts expense to record the expense of not being able to collect that debt. We credit and decrease accounts receivable because we no longer expect to get paid. Now assume a couple months later, the customer all of a sudden pays us the $800 that was owed. To record this transaction, we first have to reverse the effects of the entry we just made. So we debit accounts receivable for $800 to reinstate and increase accounts receivable. And we credit bad debts expense for $800 to remove that expense. Now the second entry in this transaction is to record cash received. So we debit cash for $800 and credit accounts receivable for $800. The debit to cash increases it for the payment received from the customer. We credit accounts receivable because the customer paid off the accounts receivable.